How to know if the market is trending or trapping you. Waves 1, 3, and 5 push the trend. Rule 1, wave 3 is never the shortest, and wave 4 never overlaps
Welcome
wave 1.
back to day 2 of our Time and Cycle Mastery 60-day series. I'm absolutely pumped to have you guys here. Okay, so yesterday we laid out some groundwork, right? Well, today we're building the absolute foundation of how to read market cycles. We are diving straight into the nuts and bolts of the market, specifically the Elliott wave theory, giving you a crystal clear lens to view price action. Let's get right to it.
How to know if the market is trending or trapping you. Man, we have all been there. You see this massive green candle, you get FOMO, you jump in, and then bam, the market instantly reverses, and you're left holding the bag. It is literally the worst feeling getting caught in a false breakout. But how do you actually know if a market is truly trending or just baiting a trap? Well, the secret sauce is understanding wave structures. Once you can read the internal anatomy of a move, you stop guessing and you start calculating.
Here's the masterclass syllabus for today's explainer. We're going to hit the 5-wave blueprint. Rule 1, the foundation. Rule 2, the power wave. Rule 3, the boundary. And we'll wrap up with avoiding common pitfalls.
All right, section 1, the 5-wave blueprint. So the core material tells us that financial markets basically unfold in this repetitive pattern. 5 waves up, followed by 3 waves down, making up one complete cycle. What we've got here is the classic impulse structure, just surging right along with the trend. You can see it clearly, right? 1, 2, 3, 4, and 5. This 5-wave sequence, this is your roadmap. It literally tells you exactly where you're sitting in the current market cycle.
Let's break those 5 waves down a bit more. They're categorized into 2 main camps, motive and corrective. Motive waves, that's your waves 1, 3, and 5. These are the ones actually doing the trending. They're aggressive, moving with the major trend. On the flip side, we've got the corrective waves, waves 2 and 4. These are essentially temporary pullbacks or price reactions against that trend. Think of it like taking 3 steps forward and then 2 steps back.
Now here is a super interesting concept, alternation. For a pattern to be a true impulse wave, those 2 pullbacks, waves 2 and 4, they can't look like identical twins. The text points out they've got to be noticeably different, whether that's in price, the pattern itself, or the time they take to play out. If wave 2 and wave 4 look way too similar, like there's no alternation at all, well then that whole sequence is probably corrective, not impulsive. You know, the market just loves variety, and this alternation is what keeps the price action dynamic.
Moving on to section 2, rule 1, the foundation.
Okay, here's the first totally unshakable law of the market. Rule 1, wave 2 never ends beyond the start of wave 1. And I really want to emphasize the word never here. The pullback of wave 2 has to stay higher than the start of wave 1 if you're in an uptrend, or lower if you're in a downtrend. It absolutely must stay within the boundary of that initial first wave. No exceptions.
The crucial thing to grasp here is the underlying logic. If the origin of wave 1 gets broken, that entire 5-wave sequence you thought you were tracking, it's completely invalidated. Boom, gone. Why? Because wave 1 has to stay intact to validate the new trend it's trying to support. If the price just drops right below that starting line, the momentum is completely dead, your thesis was wrong, and you've got to just scrub the chart and restart your count from scratch.
Now, even though wave 2 can't break that starting line, it can pull back pretty deeply. The source material highlights that wave 2 typically retraces about 50 to 61.8% of wave 1. These numbers aren't random. They're based on Fibonacci ratios. So, when you're measuring how deep that first pullback is going to go, you can usually expect it to hit that 0.5 to 0.618 sweet spot right before the real trend takes off.
Next up, section 3, rule 2, the power wave. Rule number 2 dictates that wave 3 can never be the shortest wave. Out of the 3 motive waves, so 1, 3, and 5, that third wave cannot be the runt of the litter. This single constraint is honestly what creates those massive profit opportunities for traders. Why? Because wave 3 represents the true unbridled momentum of the trend. It's where the big money is made.
Let's take a closer look at the anatomy of this so-called power wave. The literature paints a really clear picture here. First off, it's the strongest and most impulsive wave. You're going to see massive volume expansion, like volume spikes that just absolutely dwarf the earlier waves. It also frequently aligns with huge, aggressive technical breakouts, just smashing right through major resistance levels or moving averages. And mathematically speaking, a standard wave 3 typically extends to 161.8% of wave 1. In super crazy trends, it might even push to 261.8%.
It's wild.
All right, Section 4. Rule 3. The boundary.
This brings us to Rule 3, which states that Wave 4 never enters the price territory of Wave 1. This is a totally rigid boundary for standard impulse waves. There needs to be clear, empty air, like visible daylight, between the top of that first wave and the bottom of the fourth wave. That separation is exactly what keeps the trend flowing and proves the structural integrity of the whole move.
And this brilliantly illustrates exactly what a broken rule looks like in practice. Do you see how the pullback of Wave 4 just drops right below that horizontal line drawn at the peak of Wave 1? It overlaps. If you see this overlap happen on your charts, warning bells should be going off. You are not in a standard impulse wave. The pattern is completely invalidated and the trend just isn't as strong as an impulse needs to be.
So to avoid that nasty overlap, Wave 4 tends to be way shallower than Wave 2. The data shows us that Wave 4 usually retraces just around 38.2% of Wave 3. So think about it this way. Where Wave 2 is this deep, scary pullback that really tests the foundation of the move, Wave 4 is typically just a shallow, kind of sideways consolidation, right at that 0.382 fib level, just resting before that final push up into Wave 5.
Last but not least, Section 5. Avoiding common pitfalls.
The materials outline several massive, fatal errors that constantly trap traders. First up, misidentifying corrective versus motive structures, basically thinking a simple pullback is actually a whole new trend. Then, obviously, breaking the 3 core rules we just went over, that is a literal account killer. Overcommitting to one specific wave count is also huge. It makes you too rigid. You got to be able to adapt if the market breaks your pattern. And if you're ignoring those Fibonacci ratios, you're essentially flying blind without a target. But above all, emotional, hasty decision-making is, for sure, the absolute fastest way to nuke your capital.
Guys, I really cannot stress this enough. Let the market confirm the pattern for you. The texts make it incredibly clear that setting these unrealistic expectations based on some perfect forced wave count you have in your head is always going to burn you. If you catch yourself twisting the rules, or maybe kind of ignoring a little overlap just because you really want the market to go up, you are walking straight into a trap. These rules exist for one reason: to protect you from your own bias.
So, I'll leave you with a quick thought to chew on until our next session. Are your charts currently following these 3 unshakable rules of the 5-wave impulse, or are you just seeing what you want to see? I challenge you to open up your charting software right now, pull up your favorite asset, and see if you can spot a valid 5-wave structure using these exact constraints. Go on, test it out. I'll catch you back here for day 3 of our Time and Cycle Mastery series, where we'll be diving even deeper. Until then, keep learning, keep analyzing, and definitely stay focused.